Welcome to Illuminati Silver. We tell the truth about silver. Today is Tuesday, the 10th of November 2020, and we're going to cover two subjects very briefly today. One, how banks have made bumper profits out of gold, and why some believe that interest rates may actually rise sooner than one thinks. So let's take a look. Now, yesterday we produced two videos. The first in the morning, Are We Reaching Peak Gold Episode 5, which is the conclusion of our Peak Gold series, with Are We Reaching Peak Silver being published either on Sunday or early next week. And yesterday evening, entitled Why Equities Rocketed and Gold and Silver Prices Plummeted Today. And we've placed links to both of these in the description box below. Now, before we proceed to today's subject, it's worth noting that when we produced last night's video about equities rising, gold and silver prices falling, gold stood at $1,864, then down some $88 on the day, and silver stood at $23.85, then down $1.79 on the day, though that wasn't the lowest either of them had been that day. Now, currently, gold has recovered a little and is at $1,883, and silver is $24.48. But it's gold and interest rates we wish to cover this evening. First, gold. Do you remember all those nasty pumpers telling you that banks hate gold and the Fed does all that it can to suppress its price? It's this ghastly stuff that destroys the banking system. Well, let's just take a look then at a brief article published by Reuters yesterday on exactly how much banks must truly hate gold. Reuters article dated November 9th, 2020. Headline: Gold fuels big banks' bumper profits as oil bonanza fades. Lower income from oil reduced commodity-related revenues at the world's 10 biggest investment banks in the third quarter. But booming profits from precious metals means they're still set for a bumper year, consultants McKinsey CIB Insights said on Monday. Big banks have almost doubled their earnings this year from trading, selling derivatives and other activities in the commodity sector thanks to price volatility, supply disruption, and a boom in trading since the coronavirus outbreak. Massive swings in the price of oil, the biggest market, drove profits earlier in the year, but gold has taken over as the biggest earner as crude prices stabilized. A rush of interest in gold from investors and a fracturing of the market after the virus struck created lucrative opportunities for banks. The 10 largest had net revenues of $1.5 billion over the July to September quarter, McKinsey CIB Insights said, down from $2.4 billion though over April to June, but up from $1.1 billion in the third quarter of 2019. For the first 9 months of the year, their revenues were $5.6 billion, up from $3.2 billion in 2019, McKinsey said. Earnings from oil fell to $416 million in the third quarter from $1.1 billion in the second, but was still up from $341 million in the third quarter of 2019. Profits from precious metals, meanwhile, rose to $577 million, from $457 million in the second quarter and $209 million in the third quarter of 2019. Revenues from power and gas and agricultural commodities fell in the third quarter, and income from industrial metals was roughly stable. The 10 banks McKinsey CIB Insights track are Bank of America, Barclays, BNP Paribas, Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, JP Morgan, and Morgan Stanley. So, thanks to gold, the top 10 banks will have made bumper profits this year. So ask yourself, would you hate something which more or less saved your economic and financial skin? Only you can answer that. But perhaps a little more noteworthy, and maybe less provocative, is the issue of interest rates. And we've seen yields rise today, and with the much vaunted Pfizer vaccine, some are speculating that interest rates may indeed be heading back up much sooner than many economists and analysts originally thought. Let's just take a look at this. Reuters article dated November 10th, 2020. Headline: Will this time be different? Investors question the Treasury yield surge. A spurt higher in Treasury yields has investors wondering whether this time the momentum will keep going. Investors rotated out of Treasuries, a popular safe haven asset, and into sectors that could benefit from an economic upswing, such as bank stocks and high-yield credit, after Pfizer Inc. said on Monday its experimental COVID-19 vaccine was more than 90% effective. That sent the benchmark 10-year yield to its highest since March, edging close to 1%, and the yield curve sharply steeper. Previous moves higher in yield, however, have petered out, as the Federal Reserve's near-zero interest rate policy has kept Treasury trading in a tight range. Some investors say this time may be different. This was the vaccine moment the rates market had waited for, said analyst at ING. The big difference here from previous moves is that we won't need to take this back. Higher Treasury yields can translate into higher borrowing costs and thus can slow growth, but the boost can also help savers and retirees who may rely on fixed income. Andrew Brenner, head of international fixed income at Nat Alliance, said if people actually start getting vaccinated and COVID-19 case counts drop, I would expect the Fed to start thinking about changing their 2023 outlook to 2022, or maybe even the last half of 2021, to start raising rates. The Eurodollar curve from 2022 to 2024, a proxy for the market's expectation of rate hikes, surged on Monday, noted Michael Purves, head of Talbacken Capital Advisors. That was striking, he said, as it suggested a vaccine may in fact be much more important in disrupting the Fed's zero forever policy than fiscal stimulus might ever be. Still, there is skepticism that the move higher in yields would be sustained in the long run. There remains the possibility of gridlock in Washington that might hold up the passage of a stimulus bill. What's more, it isn't clear how long it might take for a vaccine to be approved by regulators and then rolled out. I still believe we are range-bound and will drift lower in yields over the next year, said Scott Berg, Chief Investment Officer at hedge fund Deer Park Road. That was seen to some extent in derivatives trading on Monday, with bets on the TLT exchange-traded fund, which tracks longer-dated treasuries, according to Chris Murphy, co-head of derivatives strategy at Susquehanna Investment Group. There had been TLT bets both ways on Monday, he said, including a buyer of a call spread looking for TLT higher and yields lower, saying that this is an overreaction and things are not going to progress as quickly as the market is all of a sudden thinking. That was a contrast to last week when traders pulled out of bearish bets that long-dated Treasury yields would rise when it seemed clear Joe Biden had won the presidency, but that his Democratic Party would face a divided Congress. That drove volume in put options on TLT to the highest since June 2019 on Wednesday, according to data from options analytics provider Trade Alert. The prospect of gridlock in Washington is one argument for little movement on fiscal policy, and therefore little movement in US Treasury yields, said Jack Ablin, Chief Investment Officer at Crescent Wealth Advisors. While a divided Congress is still likely to pass a coronavirus stimulus bill, investors say the amount may be smaller than was expected if there had been a broad Democratic victory. The election result seems like it will take between $1 and $1.5 trillion out of fiscal stimulus. So that's going to push pretty heavily on the Fed, says Ablin. Purvis said the risk to the market is if Congress coalesces around a lower fiscal package, thinking that a vaccine's around the corner, but ultimately vaccine news disappoints. That would make the rotation trade into more economically sensitive assets more vulnerable. Let's see if we get follow-through on this rotation and Treasury sell-off, said Purvis. We have our doubts. End of article. Okay, now in reality, it's far too early to tell whether rates are going to go up at the end of 2021 or not. And the odds are that interest rates in the US are likely to remain close to zero for some considerable time. However, our take on this, at least right now, and we admit the economic landscape may change, that guaranteed delve into negative rates, which many assumed was a given, may potentially be less likely. Now, of course, rising rates, and especially rising real rates, will have a dampening effect on gold and silver prices. But we do not think that should be a major consideration for now. But it may temper the speed and distance of any rise in the price of gold and silver compared to where it may have been heading. There are lots of mays and possiblies there, and we have to bear that in mind because the economic landscape is not a static economic situation. For now, we simply have to just wait and see. Thank you so much for listening. If you haven't subscribed to our channel, we would very much appreciate it if you would consider doing so, not forgetting to press the bell sign so you're notified of our videos as and when they're published. By all means, please leave any comments below, and if you are of such a mind, please pop over to our sister channel at Richard and Greg and sign up to that one too. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.